Hello and welcome to the last video for Chapter 9. Alright, this video is going to talk about self-employment tax, which starts on page 920, and then we're going to finish the chapter by talking about the FUTA tax at the bottom of page 921. Okay. I've already touched on the self-employment tax a little bit in my previous video, but the self-employment tax, if you look at page 9-23, the SE tax, or the self-employment tax, is calculated, okay, on that form. All right, and if we go to the back of the 1040, we go to page 2. And you go to line 57, okay, of the 1040, okay, you will see where the self-employment tax is reported. Okay, now you get a deduction for 1/2 of that amount on line 27 of Form 1040. But remember, that's only a deduction, not a credit. Okay. All right, and you get the deduction at your marginal tax bracket. So if you're in the 10% bracket, you would get a deduction for 1/2 of the amount on line 57, and then the actual tax savings would be, 10% of that amount. Okay, so as we mentioned in the previous video, remember, when you're a sole proprietor, okay, or you are a general partner in a partnership, okay, your income is referred to as self-employment income. All right, and you are subject to social or self-employment tax. All right, which is the 6.2% Social Security tax on both the employee and the employer, and the 1.45 Medicare tax on the employee and the employer. So when you add all those rates up, it comes out to 15.3% that is assessed on your net taxable income, all right, which is on the bottom of your Schedule C. So that's where the SE tax form starts with. It takes the amount on your Schedule C, all right, the final line on your Schedule C, all right, and then it takes that amount basically times 15.3%. Okay, now they do give you a credit for your share, or they give you deduction, I'm sorry, for your share of the SE tax. So the net tax amount, if you look at it at the very bottom of page 920 and the top of page 921, okay, what they do is they take your net earnings from self-employment before the self-employment tax deduction, and they take that amount times 92.35%. Now, how did they get that? All right, well, they take 100% minus the employer's share of the FICA tax, which is 7.65, and when you subtract those two, you get 92.35%. Okay, and that's the amount of the SE tax. Okay, and then 1/2 of that amount would be reported as a deduction on line 27 of Form 1040. So it's not unusual. I have clients all the time that have very little federal income tax liability on their Form 1040, yet they ask me, why do I owe so much, Rob? And I tell them, because while you get a standard deduction and an exemption for federal income tax purposes, all right, you don't get one for self-employment tax purposes. So it's not unusual for the self-employment tax to be much higher than the federal income tax. Okay, all right. The last thing I want to talk about in Chapter 9 is the FUTA tax. All right, the employers have in every state, all right, are subject to the Federal Unemployment Tax Act. Okay, the Federal Unemployment Tax Act, or FUTA. Okay, The gross FUTA rate is 6%. Okay, 6%. In those states where the employer is also subject to SUTA, or state unemployment tax, okay, if the employer pays their SUTA taxes on time and in full, all right, to whatever state they're in, they get an automatic credit of 5.4% against their FUTA tax. So the bottom line is that for every employee, it should cost you $42 a year in FUTA tax, which is FUTA has a taxable wage base of $7,000. In other words, the FUTA tax is only computed on the first $7,000 of each employee's payroll every year. Once the employee's payroll aggregate total goes higher than $7,000, the employer is not subject to FUTA tax anymore on that employee. All right. Okay. So 6% or 0.6% of $7,000 is $42. Okay. All right. Indiana. All right. Indiana also has a SUTA tax, which is not discussed in this book, nor will it be tested. But we do have a SUTA tax in this state. All right. And when you're a brand new employer, the SUTA tax is 2.3% on the first $9,500 in wages in Indiana, and after that, you get an adjustment every year. In the state of Indiana, will send you a notice, just like the IRS does for federal taxes. They will tell you what your SUTA tax rate is for the following year. All right, your rate goes down if you don't have any layoffs. Your rate goes up if you do have layoffs or you did not pay your taxes on time. Okay, that's it for this chapter. I will not discuss the nanny tax because it is or the 0.9% Medicare tax, because it doesn't apply to very many people, and so that'll be the end of this video.